Hi, hello, and good evening, everyone. Welcome to Paytm Money Express, a very brand new education initiative. And this initiative is all about educating new investors about different investment strategies, different products. In fact, we have been doing our Paytm Money Talk for quite some time, and we have been getting lots of inquiries, lots of questions as to can we do something for new investors, young investors who have come to the market. They want to learn about products, they want to learn about different investment strategy, and this initiative is all about guiding a new investor who had just come to the market about different products, different services, different strategies, different methods, everything. So before I start, very quickly, I would like to read out a disclaimer for this event. Investment in securities market are subject to market risk, so read all the related documents carefully before investing. All the presentations and discussions are purely educational in nature and are in no way an advice or recommendation. Representations are not indicative of future results. For more information, you can visit our Paytm Money website. I'm Neeraj Gogoi, your host for the show. Now, I'm very really excited about the topic today. And the topic that we are going to discuss in our very first show is passive versus active. You might be already investing in mutual funds, you might be actively investing, but many a times people wonder what is the benefit of investing in passive funds? Why should I invest in passive funds? What are the different instruments? You might have heard about ETFs, right? And there are different kind of ETFs are there, including smart beta ETFs. That's a completely new concept, new strategy. And to talk all about this, we have got a very interesting guest. And let me tell you before I start, I'd like to tell you that again, that Paytm Money Express is powered by Paytm Money. Welcome back. So today we've got a very special guest, Mr. Abhishek Singhal. He is head of passive and products, Aditya Birla Life AMC Limited. Now, he also drives the business strategy initiatives for alternative vertical for the AMC. Before he was head of products. Now, Abhishek has got around 22 years of experience in asset management and investment advisory services. He has been with Aditya Birla Group since 2001. In his earlier role in Aditya Birla, he has been instrumental in developing offshore funds business in Dubai and Singapore, as well as institutional business in North India. So it's a great pleasure to have Abhishek today with us. Abhishek, welcome onto the stage.
Hi, good evening, everyone. Thank you so much for the invite, Neeraj. So happy to be
Hey,
here
good
and
evening.
talking to you again.
Good evening, Abhishek. Good evening, Abhishek. It's a very interesting time, in fact, and we are all eager to hear from you as to what should be my strategy in investment. What are the different products? In fact, you know what? Few days back, we all know that so much of stress, so much of tension has developed in geopolitics. There is already a war going on, Russia and Ukraine. Now it has started even more intense. Now, how do you think going ahead, economy, market? What is your view? Can you just give us a big backdrop?
Sure. So first of all, good evening, everyone. Neeraj ji, as you talked about the most recent events, ordinarily I would have talked about Ukraine war, and prior to that maybe COVID, and prior to that maybe another event which is election, demon. Going back in history, every 2 to 3 years, 4 years, you see some event or another which sort of we believe at that point in time changes the course of markets. But when
Mhm.
you actually look back, you realize that those events were just a blip in time.
Okay.
Just to give the latest example from this Israeli Hamas issue, Markets over the weekend, and more interestingly, the Israeli markets were up on Sunday. Yesterday, markets the world over were down. India was down. And do you know, today the market has recovered all the losses of yesterday. The war
Yes,
has
absolutely.
intensified and the markets are up. So from a longer term perspective, and more specifically for investors listening to us right now, I think events make much lesser difference when you look at things from a longer frame. But when you look at short term trends, tactical trades, it is then when you have to think about these events. These events offer you opportunities to make small course corrections, but a long term strategy is always
Mhm.
determined by your longer term view on markets. So, coming back to what is our view like, as a fund house, we are more research driven, we are more fundamental in nature, and we believe very strongly in robust, sustainable growth. India is going through that large purple patch. I think the last time around we had such a strong outlook on the market was way back in 2003, 2004, when we were coming out of a big slump, a big correction in terms of economic fundamentals. We had had a recession sort of after the bust having happened, and over the next 5 years, 6 years, from 2003 to 2008, India went through a massive infrastructure boom. We saw disinvestment, PSU disinvestment for the first time, genuine PSU disinvestment happening. We saw multiple sectors participate through that rally, and we genuinely saw markets break records year after year, month after month. I think you're going to see, a mega cycle in India, not a super cycle, a mega cycle in India. Be very bullish, but be very careful as well.
Absolutely. The moment you said the current situation somehow resembles to 2003 and 4, I immediately realized 2004, what happened in 17th May. You remember that election day? And
Exactly.
that was,
Markets crashed.
yes,
Markets crashed.
and that
They
was the
shut
lowest
down.
point.
they
And
they
after
literally
that,
shut
market
down,
went
and investors would believe that this was another one of those black Sunday, Monday, Friday, whatever, after having
correct,
seen dot-com bust not very long ago. And
correct,
they shocked further had they been able to sell that day. Thanks to the
right.
markets which shut down, no trades could happen. Over the next 5 years, investors went on to multiply their capital by at
Absolutely.
least 3x.
Absolutely. I still remember after that what has happened. But fantastic. So as a new investor, somebody who is coming to the market, he has got so many different products. Nowadays, what we see is that we are all get carried away, young people get carried away, making their money, multiplying their money, in a short period of time, trading options, trading stocks. And these are the products that we have in one hand. We have got mutual funds, we have got ETFs, we have got passive, we have got active. So if you have to tell a new investor, give a new investor some kind of roadmap, what would be that roadmap to a new investor, somebody who has just come to the market, or maybe he have started investing in last 1 or 2 years, still to get the clarity and insight about what should be his approach for the long-term wealth creation.
Um, I think one of the things that I would say from a new investor perspective is to define your financial goals.
Very
Um,
good.
Without, when you
Hmm.
go on a travel, right? You go on a vacation, you make a plan. You plan out.
Correct.
I want to go out for 5 days, 5 nights. These are the places I will visit. This is the amount of money I will spend on travel, on food, on hotel, boarding, lodging. Let's say on some stuff that I'm going to do in those locations. Just like that, you have to have a map or a plan for your finances as well. You need to have goals mapped out as to, I need to achieve this milestone in the next 3 years. Maybe my child's education, maybe a child's marriage in 10 years, maybe a foreign vacation with folks every 4 years. That's a cash flow that you need to plan for. You may have to plan for your retirement in 20 years and may want to keep
Absolutely.
some money aside for medical emergencies every year, some part of money which may be in cash. So all this put together gives you a financial plan. These are all your targets where you want to keep money when you want to get money out,
Hmm.
and against which, if you want to reach that, your starting point then is, how much money do I have today? What is the net present value? The difference is what is the growth that you need to get. Add what are the cash flows that you can get, which means every month how much more money can I put in. And remember folks, more than timing, it is the time that you spend in the market which matters more to your investments. The compounding power that equities bring on the table, and now that you have a brilliant tool like Paytm Money with you, you could potentially look at multiple options across which can suit your risk appetite. Remember, risk and reward go hand in hand. The
Absolutely.
higher return potential that you want to target, there's something called the rule of 72. You divide by 72, sorry, you divide 72 by that number. Either you can get the number of years that your money will double in, or you need to target that return to double your money. So either way, you need to figure out how much risk do you want to bear. Are you okay with if markets drop 25% in a day? This is the example that Neeraj was talking about in 2004 at the beginning of a massive, massive rally. India versus Australia 2 days ago, 3 days ago, 2 days ago. Uh, you lose 3 wickets on the top just at 2 runs, and then you end up winning the match. It was pretty much like that at that point in time. We had a market shutdown, which is unprecedented in almost every major market around the world. When markets shut down, it basically means you're doomed. But it was only a blip. If you remained invested, even in an index, you ended up doubling your money in the next 3 years. In mutual funds, you ended up tripling your money in the next 3 years. And if you were in the right set of securities, stocks, etc., you could have maybe quadrupled or pentupled your money as well. So coming back to the plan, uh, don't take advice just like मैंने ये खरीदा था तू भी ये खरीद ले. Why? Do some bit of
Yes.
your own research. Um, don't go by hearsay. Of course, there is qualified advice available. Listen to experts. Given this platform, you will have, I think, more and more experts coming through, and through Neeraj, you can reach out, ask as many questions, ask all your doubts, but be systematic, be disciplined. When there are profits on the table, book your profits. There's no don't be ashamed about it. Take some profits off the table, reinvest when the markets fall, and markets will continue to give you that opportunity. Announcement of a war over the weekend was sort of an opportunity if somebody would have put money for one day. Markets went down yesterday, markets came back up today. I don't know what's going to happen tomorrow. Markets could again correct by 100 points tomorrow, and they could be back up 100 tomorrow, day after tomorrow. But from a longer term perspective, you need to be optimistic. um, Understand your risk and return profile. Be clear about where you believe is your conviction. I believe my conviction is in, let's say, financial services or
Mhm.
healthcare as a sector or IT as a sector. I will go and buy securities there. But if I don't know how to look at these companies, whether to buy an Infosys or to buy, let's say, an L&T, LTTI, or for that matter, a TCS, I'll go and buy an index. These are some of the other tools available. There are experts out there who are creating these packages for you. Um, and I don't even know whether to buy financial services or IT. Okay, go ahead and buy a Nifty 50 at least. Buy India. India is reflected in a Nifty 50. So life has been made easier by mutual funds. We have all kinds of categories available in funds today. You have active funds and you have passive funds. Active funds are the ones which are run by qualified managers who do a lot of research. They rely on
Mhm.
advice coming from analysts who spend their lives researching these companies, providing their inputs with respect to when to enter, when to exit, what to avoid, what to take, and then the fund
Hmm.
manager complements this with a qualified view on markets, qualified view on economy, those particular sectors, and takes a call on what will generate that money, what will generate that return for the investors.
Yeah.
Um, if you're talking about new investors, I think the first thing that you should look at largely is large caps. This is a safe bet. Like a swimming pool, this is the shallow end of the ocean, um, or a shallow end of the swimming pool in terms of risk. Of course, these are good for you because A, they are consistent, B, they are very safe relative to the other securities because they are very, very liquid. They are typically giant caps. These are companies like Reliance, HDFC Bank, TCS, the marquee names in every business that you can conceivably think of. And then you should, as your risk appetite builds up, start looking at mid caps and then small caps. And if you are more adventurous, start looking at sectors. And maybe
Correct.
as
And
time progresses, we'll talk about more advanced stuff.
absolutely. In fact, we have already started receiving lots of questions from our audience. In fact, I also request अगर कोई भी questions आपका mind में है, please feel free. Go ahead and type your question in the chat box. So I'll just take one, two questions in between, and then again we'll get back to our track of discussion. So first thing, I think Varun is asking one question. What do you think about international ETF? So you talked about large cap, you talk about small cap, and in fact, in the small cap, we have seen a very huge rally. In fact, today also, my mid cap and a small cap, they have rallied more than 1%. In fact, Nifty also. So in the same category, so how do you think about can people do you suggest a new investor going to international investing, diversifying his portfolio to international funds as well? Can you give some take on that?
Absolutely. It makes a lot of sense. Um, Very interesting point of view. India is big, right? But you know that India
Mhm.
is less than 2% of the global market cap. Half of our population is using Apple, and the other half is
Mhm.
perhaps using Samsung and some of the other Korean brands. But where are these companies? These companies are not Indian companies. These companies are sitting outside, right? The largest selling brands in India in terms of cars are companies with technology coming from outside India. Won't you want to own these companies? How do you own these companies if these companies are not in India? So this is
Absolutely.
exactly what happens if you are able to buy these companies through some vehicle. International ETFs, incidentally, do the same thing for you. They buy or they package some of the largest companies in the world, like let's say Tesla, Facebook,
Mhm.
Google, Apple, Netflix, Nvidia, same companies that the products of which, services of which you are enjoying day in, day out, which you probably know by name, but you could not think about them in the Indian context in owning them. Through buying these ETFs, indirectly you end up buying a bunch of these companies. So, from a diversification point of view, you should definitely buy international ETFs as well. Maybe somewhere between 5% to 20% of your portfolio should be in
Mhm.
international markets. If you are a more advanced investor, maybe a higher proportion. If you are a newer investor, maybe 5 to 7%, 5 to 10% of your portfolio.
5 to 10% of your portfolio should can be allocated towards international investing. In fact, again, the first thing you have discussed, you have said some very important points: planning, then allocations, then risk profiling, and one of the very important thing you said that time in the market is more important than timing the market. So great time ahead. Now, second question, in fact, very related question. It's by Mr. Roshan Iyer. So he's asking the question related to asset allocation. What is the asset allocation you would suggest for someone who is between 25 to 30? Should I do all my passive portfolio or a mix of active versus passive? This is the complete theme of the whole discussion today, in fact.
Very, very interesting question from Rohan. So I think there are actually two questions in that one question itself. Number one,
Mhm.
what is the asset allocation that one would look at, and second, can you achieve that through all passive, all active, or
Hmm.
should it be a mix? To answer the first one, Rohan, if you are a young investor between 25 to 30, I would say you have a whole life ahead of you. And of course, you should build an aggressive portfolio. Perhaps maybe even 100% in equity if you can afford it. And
Absolutely.
this I would recommend be a typically a more longer term portfolio unless you have interim cash flow requirements. Second, um, should it be a passive portfolio 100% or should it be a mix of active and passive? I would say um, today passive is a space. And what are passive funds, by the way? Passive funds typically mean ETFs, exchange traded
Hmm.
funds, index funds, and some sort of FOS, fund of funds. Uh, Today, passive as a space offers you so much of versatility. You could potentially build 100% of your portfolio through passives itself. You can buy, a bunch of ETFs, Nifty 50, Nifty Next 50. There are mid cap ETFs. There are small cap ETFs also available today if you want to buy. But if you're somebody who does not want to do too much of research, just simply buy and forget. Maybe buy 50% of Nifty 50 and the rest of it in a bunch of even active funds, maybe some small cap active funds where fund manager can do the stock selection, try and beat the market. But in the large cap space where there is very
Hmm.
little or no alpha, no outperformance available, just simply go for an ETF. Nifty 50, Nifty Next 50, maybe a mid cap, and you are done.
Perfect. Now, when we are talking about passive investing, we have mentioned about index funds, fund of funds, ETFs. These are basically passive investing. Now, what we have seen of late is a tremendous popularity for passive investing. So, can you tell us why so much of popularity? Because the normal gut feeling says a fund which is actively managed supposed to give better return than fund which is passively managed. So why we are seeing so much of popularity of passive instruments, whether it's a ETF or index funds?
Neeraj, the Indian market has mirrored the international market
Hmm.
with a lag of maybe about 10, 12 years. Um,
Okay.
so what we saw happening in the rest of the world is now starting to happen here in India as well. What we call as alpha outperformance,
Hmm.
where fund managers build a portfolio, buy stocks, buy and sell stocks over time, and try to beat
Hmm.
indexes over time. This alpha has eroded in India in certain categories. Now,
Hmm.
we're sharing a certain data point here. What is driving this passive industry? If you look at this snapshot, this data chart which S&P creates, this is a half
Hmm.
yearly survey, a half yearly review of all markets in the world that they do. This one is specific to India. You can see that in the large cap category, where the benchmark is the large 100 companies, the S&P BSE 100 companies, 1 year, 3 year, 5 year, more than 90% of fund managers are actually underperforming the benchmarks despite paying maybe 1.5%, 2% of
Hmm.
expense ratios. If I'm going to be underperforming the benchmark, maybe I'm better off buying the benchmark itself, which is a good portfolio. It's outperformed over such a long period of time. If you look at even the 10-year period I talked about, right, time in market rather than timing, even in that 10-year period, two-thirds of the market underperformed index. So perhaps we believe that I'm better off buying an index and go the passive route. As you go further deeper into an ELSS, which
Hmm.
is a more diversified portfolio, you look at mid cap, small cap as a segment, you can see that gradually the same trend is starting to play out in these segments as well. In the more diversified category, roughly half or two-thirds of the managers are underperforming. In small
Hmm.
and mid cap, interestingly, there is still significant alpha available. So, which
Hmm.
is why you see that only up to half of the managers are outperforming, the other half are still underperforming. And this
Hmm.
is why I believe that As time goes by, alpha erodes further. You will see more and more adoption towards passives. The second aspect is that the platforms like Paytm Money here have made life so easy, made information so fast for investors. Most investors want to be in control of their own destinies or of their finances. By investing in passives, you're not dependent on somebody else to pick stocks or pick segments or sectors for you. You can just
Mhm.
simply take a call. I feel bullish about, let's say, banking, because
Mhm.
HDFC has now become, let's say, the top five bank in the world. I will just simply go and buy, if I'm not too sure about sectors or companies, bank index or bank ETF. And I can just simply go buy bank ETF, 26-27% of HDFC Bank, another maybe 18% of ICICI Bank, 12% SBI Bank, and so on and so forth. The top banks are already in my portfolio. Digital movement is the second big driving force. And the third is that even the government today wants more and more transparency. Passive funds are extremely transparent. ETFs, you can see your portfolio day in, day out. You can just simply go and visit any of the exchanges website, and you can see what your running price is. Your NAV in terms of the price is published every second on the exchange. So this is what makes ETFs so powerful, so popular with investors. In no time, in less than 5 years, passives has now become more than 17% of the total mutual fund assets in India.
Wonderful. When you talk about passive, you talked about large cap. Uh, Now, when you talk about index funds, the first thing that comes to our mind is Nifty 50. Then we have got Nifty Next 50, and then Nifty 100. So there's a question from Mr. Vikram Prabhu. His question is related to that. So what he's asking is, in large cap space, what's your recommendation? Nifty 50, Nifty Next 50, or next Nifty 100? Now, if somebody have to choose Nifty Next 50, then why he should be choosing Nifty Next 50? So as a whole, if you can give us a guide guideline.
Okay, so if I'm a beginner, day one
Yeah.
of my investment, I would just simply go ahead and buy Nifty 100. It's a combination, it's a
Okay.
50-50 combination of Nifty 50 and Nifty Next 50.
Hmm.
It gives me exposure to the top 100 companies. I don't have to
Hmm.
think about it at all.
Hmm.
But if I want slightly higher growth, going by the past track record and by the performance of these indexes and the construct of these indexes, perhaps a little more of aggression will come if you buy a slightly higher proportion of next 50. Nifty 50 is giant companies, the top 50 companies by market cap in India. You have HDFC Bank, Reliance Industries, TCS, Infosys, Wipro, so and so forth. You think of a large company, genuinely very large company, and it's Nifty 50. But the problem with Nifty 50 is that it's dominated by two sectors: BFSI, banking financial services, and IT. Roughly 51-52% of Nifty 50 is built in these two sectors. So, if you want a more balanced sort of exposure, you may
Hmm.
want to go in for Nifty Next 50.
Okay.
Over time, over the last
Hmm.
10, 15, 20 years, we've seen Next 50 has actually beaten Nifty 50 in most parts of market cycles. It's of course slightly riskier as well compared to Nifty 50, but it's again a large cap index. I would recommend, if you don't want to spend time thinking about these questions, just buy 50% Nifty 50 and 50% Nifty Next 50. And as markets go through their cycles, we can do plus and minus.
Okay. So you said as a beginner, one can go for Nifty 100, but if you gain a little bit of experience, you can go 50% into Nifty 50 and 50% into Nifty Next
You can
50.
go more than 50% into Nifty Next 50, maybe a
Acha,
two-third Nifty Next 50 and one-third Nifty 50.
more on the aggressive side.
Yeah. And if I
Okay.
want to play it safe, two-thirds of Nifty 50 and one third of Nifty Next 50.
Mhm. So many times again, there's another questions. In fact, the same question by Mr. Vikram Prabhu. What is the impact cost in index investment? Can we build a passive only portfolio for long-term investments? Say, let's say 20 years. If we have to invest for 20 years, can we go for passive only kind of a portfolio? So in fact,
You
I would
can.
like to request all the viewers, if you have got any questions, please feel free, go ahead, type your question in the chat box, and Abhishek would love to answer your questions. Yes.
So, Vikram, you can build a passive only portfolio for a 20-year period. As we just saw the data, over a
Hmm.
10-year period, the probability is a 70 plus percent probability is that your investment in a index will will be the best performing investment portfolio in the country. Now,
Hmm.
for a 20-year period, why is a passive only portfolio a good bet? Because indexes keep on churning themselves. Once you buy them, there are two three costs that you pay brokerage, you pay something called a spread, because when indexes trade, you're buying it from somebody is selling it to you at very very small, very marginal pennies. And that's about it. The recurring cost that you pay is the total expense ratio. In case of Nifty 50, for example, the range is about 4 or 5 basis points, and hence it's a very very inexpensive option to buy. Your total impact or your total cost of investing is not more than 15 to 20 basis points. This is what you get for a portfolio that multiplies, which delivers a CAGR of about 14%. CAGR is compounded annualized growth rate, which has already delivered over 14% per annum CAGR for the last 20 plus years. Now, can you build an even more aggressive portfolio? As I said, there are more ETFs available. You could build a passive only, ETF only portfolio, which could be riskier, which could generate higher returns, or which could be safer as well. By the way, there are equity ETFs, there are debt ETFs as well, and then there are gold and silver ETFs as well.
Okay, great. So when you talk about again passive investing, one of the very interesting area that is developing of late is a smart beta. So many new investors, people wonder what smart beta investing is all about. Can you tell us briefly what smart beta is and what are the different types of smart beta and how do they perform compared to other passive investment instruments?
Okay. When we started out differentiating between active and passive, we said that active funds are where the fund manager is taking a call for you, whether to buy a
Hmm.
stock, sell a stock, when to buy and when to sell. So the level of involvement, level of churn, trading is quite high in these portfolios. In case of passive funds, we just basically take a particular index and just mimic that index. Typically, these indexes, the portfolio is determined by an
Hmm.
algo or by a formula, if that is the appropriate word. Typically, once or typically twice a year, or maybe maximum 4 times a year, this portfolio churn happens, and not a large churn. Some companies which are not performing are thrown out. Some companies which the logic believes are performing come in, and that's a purely passive strategy. Somewhere between these two ends is a strategy which is a semi-active strategy. This is called a smart beta. How does
Hmm.
the smart beta work? Smart beta is basically a quantitative technique that identifies certain triggers. Let's say on a quarterly basis or every 6 months, I run a formula and I find out the top 30 companies which have the best ROE, return on equity, which have the best ROCE, return on capital, Then the lowest risk or lowest debt to equity. And then I also look at most consistent earnings growth, EPS growth,
Hmm.
and put them as a 25% weight each. What do I get? I get something called quality. Quality is that smart beta. The
Hmm.
moment I run this screener on, let's say, the top 200 companies in India, every, let's say, 6 months, I'm able to screen out companies which are not qualifying and get companies in which are qualifying. We ran this experiment for, let's say, 10 years. And we found that this has actually ended up performing better than Nifty 50 also, or Nifty 200, from where these 30 companies were selected. What do
Hmm.
we get? We get a smart beta. So this is a more involved sort of approach than just simply replicating an index. But again, remember, this is a part of that same quantitative approach. This approach is now built in as an index, and the fund manager just simply replicates this index. Smart betas are for typically investors who understand the risk in market environments where, let's say, there is a lot of bullish momentum, a lot of teji. Typically, quality as a factor does not perform so well. It will deliver positive results, but not as much as the market, and hence your portfolio might underperform. Um, but at the same time, if the market is in teji, a smart beta called momentum will give you that extra bit of boost. We were talking about markets being up today. Nifty Sensex were up roughly about 0.6 0.7%, I think, and mid cap and small cap were up, I think, about 1.3 1.4. I think momentum was up 1.6. It delivered something extra. Now that extra, because of sentiment, because of that extra bit of factor, more companies which are in bullish momentum getting screened, is that extra bit of outperformance delivered because of the smart beta. And likewise, when markets are falling, smart beta could fall more than the market also. So whether smart beta is for you or not is dependent on whether you understand that risk. But I personally believe that if you are a nuanced investor, if you understand portfolios, if you are a little bit experienced, 10 to 15% of smart beta is good for your portfolio.
Great. So that was my second question. In fact, I was thinking, and you have already answered it. So yes, so if you understand the portfolio and if you really understand the risk, then you can always go ahead with 10 to 15% with the smart beta. And I think going ahead, as you said, Indian economy, Indian market is poised for a very good time ahead. Probably one can look into it. Now, what about sectoral investment? Is it possible through passive investing strategy in sectoral investment? For example, like IT sectors, or somebody want to invest in pharma or something, banking sector, and who should go for this kind of investment? Can you do it through ETFs or mutual fund, index funds in a passive way?
Absolutely, you can. Absolutely, you can. Um,
Hmm.
just like for Nifty 50, there is an index. Nifty Next 50 is an index. Nifty Mid Cap is an index. Um,
Hmm.
NSE and BSE both have generated indexes which screen out companies depending on which industry they belong to. The most popular sectors today are banking, as you rightly pointed out, IT, which is the second largest sector in Nifty 50, incidentally, healthcare, which is a very popular high growth sector, and then you have consumption, which is available as a sector. PSU is available as a sector. Auto is available as a sector. In fact, every conceivable high interest sector today has been built into an index. Um, there are passive funds available for most of them, not all of them as
Hmm.
yet, but even as an AMC, we are endeavoring to offer almost all of them to you. Um, the larger sectors, or the sectors which are dominant in the large cap space, are very, very good for you to invest in if you have conviction in these sectors. I would say that banking as a sector is pretty good to invest from a long term perspective. In any economy has to do well, banking in that country has to do extremely well, and hence, and given the fact that even 30% of our own Nifty 50 is in banking, it's a wonderful index to be in. There are ETFs available. There are also index funds which are available. And then IT is again available through ETF as well as index funds. These are the two that you should definitely consider. There's again healthcare, as I said, available largely through ETFs. If you look at the ETF space, you have every conceivable sector represented there today.
Wonderful. So, Abhishek, we had a fantastic discussion. In fact, you have really, really covered wide spectrum of passive versus active investing, how much portfolio, which are the instrument, in fact, they can look into. Um, what is your final advice? What is your final words to investors? Somebody who is new, as well as somebody who is already investing in the market. Your final words to the investors.
So I would, start by saying that have your financial plan in place first.
Absolutely.
Goals, where you are, what is that you are targeting for, and accordingly build a portfolio. Given that measured amount of growth. If you are young, of course, you should have a more aggressive portfolio, like Rohan had asked for. 25, 30 year kind of guy. Or if you are older, you should have a more conservative sort of portfolio, more
Mhm.
fixed income and less of equity. Um, and somewhere midway, maybe a 50-50 sort of a portfolio, depending on what your life goals are. But at any point in time, be cognizant about the cost of your portfolio, which is what is determined by the activeness or the passiveness in your portfolio. You can actually build a 100% passive portfolio also if you wish. But however, in some spaces like small caps, there is reason why you should invest with fund managers as well. It's a deep space.
Mhm.
You have more than 250 companies there you could participate in, and it's very difficult to distinguish, and hence research is useful. Large spaces, no questions asked, you should go in for an ETF or an index fund. Even for a mid cap, you could look at an ETF or an index fund. Build a portfolio, review it frequently, maybe every 3 to 6 months. And if you believe that there is good amount of profit, solid amount of profit being generated more than the market earlier in the cycle, book some profits, reinvest them when the market's correct. Whenever there is an opportunity, ensure that you capitalize by investing more. Um, Events happen. COVID happened, markets went down 30% in a few weeks, and then they came back up 35-40% in the next quarter itself. Hindenburg happened earlier this year, markets corrected very sharply for a couple of weeks, so much so that the entire year's return was almost wiped out. But in the next quarter itself, market set a new benchmark. And now, a new event has happened recently, just the last week. Don't be too worried. I think markets are factoring in some sort of a resolution or an early end to this conflict as well. Whether this goes on or not, take a longer term view of the market. Markets are poised for high growth over the next several years. So you need to be optimistic about life, need to be optimistic about markets.
Lovely. I think it was a wonderful, wonderful time talking to you, Abhishek, today. And I'm sure our viewers, they have gained immensely. At least they get a very clear visibility what should be done. Not to get nervous. Things will come and go. But yes, the Indian prospect of Indian economy, Indian market is very high. So we need to remain invested in a very disciplined way. That's the message. In fact, much more than that. And with that, I'd like to thank you, Mr. Abhishek, for being a part of this program today. And also, I'd like to tell our viewers that this is a welcome session. And after this session, I'm going to take them through about different investment instruments that we have in Paytm Money platform. They can invest in bonds, they can invest in equity, they can trade in derivatives, they can do so many different things. If you're new, I'm just going to take you through that. Abhishek, thank you so much, and looking forward to see you next time.
Thank you so much, Neeraj. See you all. All the best.
Thank you. Bye bye. Okay, guys, that was Mr. Abhishek Singhal. We had a fantastic discussion, right? So here it is. You have to now invest in mutual funds, ETFs, stocks. You can, if you're expert enough, skill enough, you can invest directly in stocks as well, right? There are sectors that he have said it's going to grow. So yes, we can do so many things. So what I'm going to do in this section is I'm going to take you very quickly through our Paytm Money platform, right? And going ahead, we are going to discuss more and more about this. But today, I'm just going to give you a small introduction. So I'm sharing my slides. I'm sharing my screen. Can you all see my screen? I'm sure you can see my screen. Okay, so here it is. Basically, this is what we call basically when you log in to Paytm Money platform. Of course, next time I'm going to show you through from our mobile phone as well. But due to a little bit of technical problem today, I'm going to stick to my desktop only. Okay, so here when you log in for the first time, that is what exactly what you see, right? Here, what we call the market watch. There are several market watch you can see. There are 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 market watch. You can add stocks in your market watch. Now, in this market watch, I have got 44 stocks. You can add even up to 50 stocks also. These are all different stocks that I can add. And similarly, here you can see indices. Then here there are two segments, basically, stocks and FNO. Now, if you're looking for stocks, that is where this is a stock segment, and you can put your stocks in different market watch. Now, one of the very important thing when you invest in stocks directly or trade in stocks, right? If you're a trader, technical analysis is very important for you, right? Or if you're an investor, then of course, both fundamental analysis and technical analysis both need to be taken into consideration. So what I'm going to show you today is how can you use it. Now, for example, again, let me tell you that these are purely examples. These are not recommendations to buy or sell. Okay. For example, when I give click here and show you the chart of State Bank of India, it is not a recommendation. It is simply and using the chart to explain it. Okay. So here, these are called technical charts. If I take it, make it larger, this is where I can make it larger. State Bank of India. It's coming on the full screen. Okay, this is State Bank of India. Now you can see the whole chart. Now this is a very advanced chart, and of course you can add trading view charts as well along with this. So what you get is here is that first you can change the type of the chart. You can make it a candlestick chart. You can make it a line chart, bar chart, baseline, Hangshan Ashi, Kagi chart, Renko chart. You can make different kind of chart. So many of you traders might be using Renko chart. So you can also create a Renko chart in this particular platform. Okay. So this is how you. Now, second important thing is the time frame. If you're a short-term trader, you might be trading in a 15 minutes time frame in a normal candlestick. Let me convert the chart into a candlestick chart. So this is what you do. Convert it to a 15-minute chart, convert it to a 1 hour chart. This is an hourly chart. So if you are kind of a swing trader, and if you are willing to hold your position for a few hours to a few days, you can always go for hourly chart, right? The moment you check hourly, this is what the hourly chart comes. Now also you can make daily chart. Daily chart is a default, and then higher time frame charts. These are called weekly and monthly charts. Now, why do you want weekly and monthly chart? Weekly and monthly chart is basically for a little bit longer term investment purpose. If you want to hold a stock for longer term, right? Then what you are going to go for? You're going to go for weekly or monthly chart. Now see State Bank of India. When we are seeing this particular weekly chart, what we are seeing here, we are seeing now here is a toolbar. The moment I click here, see this all the toolbar appears, right? So here I can see my trend. So now see from here I can draw a trend line. Okay. Now if you look at it, if you look State Bank of India, what we have seen is that the stock is in a very strong uptrend as a whole. Since 2020 March onward, the stock is in a very strong uptrend. But of late, in last few since you can say last 1 year or so, the stock is moving sideways, right? So another very important point is this is the resistance area. Can you see that? Every time the stock comes here, goes back, comes here, goes back. Again, it's trying to comes up. Now this is something work like a spring. It works like a spring. So once this area is broken out, so what we can see is that another kind of a big up move might come in that particular stock. So if you are a long-term investor and if you are fundamentally convinced that State Bank of India should be included in your portfolio, the right time, one of the right time to time is let it break the resistance. The moment the resistance is broken, the stock is going to go in a new uptrend. So that is what you can use. Now, similarly, you can look at from the monthly perspective as well. So the view is not going to be greatly different, but in a monthly time frame, what happened? Every candle represents one month. So if you're a long-term investor, you are always going to consult higher time frame, monthly time frame. Okay, so you will get everything in this particular platform. You can use different indicators as well, right? One of the very important thing nowadays, lots of traders use are indicators. So with the help of indicators, you can create your own trading system. So you might be wondering, what do you mean by trading system? Now, trading system, if you are a trader or even if you are an investor, right, you need to have a decision making process by which you are going to decide when you are going to buy, when you are going to exit, sell, where you are going to put the stop loss, how you are going to decide it. You are going to decide it with the help of a logic. And this particular logic, with the help of technical analysis, is called a trading system. So you can create a trading system with the help of indicators. Here I am using MACD, that is called moving average convergence divergence, right? Can you see this? These are the two lines. Now, very simple interpretation of MACD is this black line is called a MACD line. Can you see that? This is moving average convergence divergence line, and the red line is called the trigger line. Okay, so when the MACD breaks the trigger line from below, this is where the buy signal, and this is when the MACD moving average convergence divergence crosses the trigger line from above. Can you see this point, guys? This is what we call the sell signal, right? This is exactly where the sell signal is generated. This is exactly where the sell signal is. So corresponding to this point is this is exactly. So if you're a long-term investor, if you're a delivery, so you know that this stock is now preparing to go down. So you can exit, you can you can sell your stock and book your profit. Okay. Similarly, this is again, can you see this point again? Same is the case. This is exactly what we are seeing here. This is the point we are seeing. The MACD line is crossing the trigger line from below. It means this is the area where you are getting the buy signal. So if you are willing to buy that stock, sorry, if you're willing to buy that stock, this is the area where your technical analysis or your trading system is saying that this is the area that you should be buying that stock. When the price is around 565, now the price has gone to 590, it gone to 605. So this is how you can use a indicator, technical indicator, as a trading tool. You can also use RSI, moving average. Many people use two, three multiple different moving average. They create a trading system out of moving average. And I have got, we call it sequencing pattern. Sometimes I'm going to explain to you, but you can all do it here in this platform, right? You can use RSI, you can use super trend, one of the very exciting, very good one, in fact, lots of new traders use, and that is what we call the super trend, right? So I'm going to use, so what you are going to try here, SUP super trend. Can you see that? Super trend. So I'm going to change the parameter for my suitability that is 14 and 2. That is what I use. Now see, the super trend basically tells you when to sell and when to buy. The moment the price goes above the super trend, this line is a super trend line. Can you see that? Sometimes it's going green and sometimes it's going red. Now, usually when the price is above the super trend, right, the super trend become green. It means it's a buy signal. Okay, let me put it this way. So this is a super trend buy signal. This is where it has given a buy signal. Now, when the price goes below the super trend, that is where it gives a sell signal. Okay, so this is how the buy signal and sell signals are created. So as a trading system, you can combine 2 3 different indicators for your trading purpose. If you're a very short-term trader, you can go for 15 minutes. Now see, in the 15 minutes intraday basis today, this is where it has given you a buy signal, right? This is where it has given you a buy signal, right? This is yesterday, right? This is where it has given you a buy signal on an intraday 15 minutes time frame. Can you see that? That is where was the price? The price was here. So as a trader, you could have bought here. As a trader, you could have bought here, right? And then it has given you a sell signal. Today, towards the end, today we have seen a huge rally. Yesterday, the market was falling. So here at the end of the day, we got a buy signal, and today we got an exit. So short-term traders can also use it. Now let's go back. Now another very important part, what we call is FNO, futures and options. Now this particular platform is powered by so many features. One of the features that we use is what is called open interest. I'm sure you might be knowing open interest. Okay, so if you don't know open interest, please do attend our training program on derivatives. We conduct master classes. So there we explain what is the strategy with respect to open interest build up, increase and decrease in open interest, along with the technical chart. Okay, so this is very important. You can look at option chain. You can look at, now this is Nifty. You can see Nifty. This is put open interest 19,600. We have got the highest put open interest. Then green bar. It means currently where is the market? 19,689 is the market. So it means 19,600 is going to work as a very strong support. No doubt today the market has reversed, market has become bullish. So it means 19,600 is going to be a very, very strong support for you, because we have got huge put interest built up at this particular strike rate. So this is going to work as a support for you. Now, if you look at the resistance, where you can see call build up. So the red line basically talks about call build up. So there is no much. 16,600 very small, 16,650 very small, 16,700 very small. So there is no significant call build up is happening as yet. Okay, so that is how you can interpret. This is a very good platform. Then you can look at this is where you can go for option chain. Let me show you the option chain also. That is option chain, Nifty option chain. In the Nifty option chain, you will see this is what the strikes are. Okay, this is where the strikes are. This is where the delta, call delta. These are what the put delta. Put delta. Again, if you don't know what is delta, so no worries, you can attend our master classes, and you can attend our training program. We have got strategies using delta. This is called implied volatility, vega, theta, and gamma. These are called Greeks. So if you are an option trader, then please remember you have to learn option Greeks, because ultimately, if you're bullish, right? For example, I'm just giving an example again. If you're bullish on State Bank of India, you want to buy a call option. Which strike call option you should buy? Which expiry call option should you buy? Should you buy current month? Should you buy next month? So all these decisions are going to be taken on the basis of these parameters. So we're going to explain all those things. Okay, so this is where. Now this particular portfolio segment, whatever stocks that you have, I don't have any stocks as of now. I've got basically mutual fund, and also I've got trading positions closed. So this is where you can see the stocks in your portfolio. This is where you can see the positions that you have traded. Now this is where you can see the orders that you have placed today. Now here you can see the funds. Okay, so this is a basically a brief introduction. Okay, just a sec. Okay, okay, great. Thank you so much. So this is how we have we stop. This is how a brief introduction I have given in Paytm Money. Also would like to tell you that in Paytm Money platform you can buy bonds also. You know, bonds, the government bonds, the corporate bonds, and you know the bonds are very you know, basically these are the instruments which are used by institutions or super high net worth individuals. Now retail traders also can do it, and we have created a platform through Paytm Money. You can choose your bonds, you can directly invest in bonds through our platform, right? There are so many different tools are there. Going ahead, I'm going to show you more of those tools. But anyway, I think if you have got any questions, please feel free. Go ahead. You can ask your question in the chat box. I think that's all for today, and going to see you again. We are going to have two more sessions. We are going to have we will continue to have sessions every weekly on those different investment uh, tools, investment strategies, instruments, approach. We're going to keep on having it on a weekly basis so that people can continuously keep on learning and keep on improving their investment skill, right? So with that, I'd like to say thank you to all of you for being a part of this program. And if you have any questions, please feel free to write to us, uh, you know, drop a mail to us, and would love to answer your question. Thank you so much. Bye bye.